Did you know that it has been, at time of recording this, almost a full year since our last interest rate hike? For nearly 1 full year, we had higher but very stable interest rates. And the question on everyone's lips: when will we see the first interest rate cut? Now, to answer this, we should perhaps turn to inflation. And unfortunately, global inflation remains somewhat high. Now, core inflation in South Africa, which covers all the goods and services except the volatile food and fuel prices, continues to rise. Globally, the trend is that services rather than goods are becoming more expensive. Food price inflation hit its highest level since 2008, last year, and has since come down. The problem, however, is that weather patterns and excessive drought conditions could see food inflation pick up again. Now, commercial banks have tightened their lending standards in a response to potential defaults on mortgage payments, as the South African consumer is now coming under immense pressure. All of South Africa's major banks have flagged growing credit impairments. In other news, perhaps the US economy continued its strong growth trajectory in the first 4 months of the year. Interestingly though, emerging markets outperformed developed markets in April as EM equities and commodity prices rose. Now, our markets closed on 76,076 points, while 1 year ago it closed on 75,940 points. The rand is trading at slightly better levels than 1 year ago, as it closed end of April at 18.79 to a dollar. April had a mixed bag of returns. The ALBI had a positive 1-month number, up 1.37%, and the Aussie returned 2.95% for the month of April. While local listed property gave up a bit of its previous returns, and the MSCI Apr was down 3.8% for the month. Now, this month in our financial planning column, we feature again the two-pot retirement system. It remains a topical discussion point, especially for financial advisors facing a lot of questions from their clients. Now, 1 September 2024 is the due date for the two-pot retirement system. And as of this date, all contributions to provident, pension, and retirement annuity funds will be split into 2 components. These components will be the 1/3 allocation to a savings pot and the remainder 2/3, which will go towards a retirement pot. Now, the savings pot will be accessible prior to retirement. Another question perhaps: what does vested rights mean? Now, vested rights refer to the rights that you already have in relation to your retirement investments, which the new legislation protects. This means that all your retirement savings up until date of implementation will form part of your vested component. Now, May will be a very big month for South Africa as we head on over to the polls. We have a very interesting chart that we share this month highlighting the growth in registered voters and eligible voters. However, the unfortunate point that we make in this chart is that though eligible voters really have grown dramatically in the last 10 years, the non-registered portion has also grown substantially to 13.7 million people. Technically, the registration rate has dropped from 80% in 2014 to 67% in 2024. The positive news thus far is that the polls indicate a higher probability of a policy-friendly and very centric ANC coalition, and our hope is that this will not just be the base case, but that it will in fact play out in favour of all South Africans. One of the 4 pillars of outcomes-based investing is managing risk. Now, risk is often a very relative term and often also a very statistical term. But what does this mean for investors? Investors don't necessarily understand standard deviation, so what if you could define risk differently? What if you could define risk as the percentage of times your portfolio has negative 1-year returns? And if it does have a negative 1-year return, how bad can it get? What is the actual worst number? Now here we show the guarded growth model portfolio versus the multi-asset medium equity category. And you can see that the percentage of times the portfolio delivers a negative 1-year number is less than that of the ASISA category. And when that negative year occurs, the worst number over the recent history was far less than that of the category. You might ask, why is this important? But imagine planning for your clients' most essential goals. Knowing these numbers can ensure you, as the advisor, deliver not just suitable advice, but also match the most suitable investment solution with your client's investment goals. Now we share, as always, the market snapshot containing up-to-date ASISA category numbers, bond yields, bank rates, and our excellent model portfolio return data. Now be sure you reduce uncertainty for your clients. Consider outcomes-based investments.